Hello and welcome to our conversation on understanding the financials of a company. And in this session, we will try to understand the financial position, the latest IPO of Zomato. But all the information for this presentation are based on the um, red herring prospectus submitted by Zomato to SEBI. So let us continue. Zomato has been changing its form and name over a period of time. In 2010, it was a private limited company as a foodie bay. In 2012, the name got changed to Zomato Media Private Limited, and 2020, it became Zomato Private Limited Company, and in 2021, it became a Zomato Limited, a public limited company, because they were planning to tap the capital market with its IPO. So we can see that the name and the form keeps on changing for a particular company. And this is not just the case with Zomato. Most of the companies go through this process of changing its form as well as changing its name. What's the business of this company? The business is it a technology company or a marketing company or a restaurant service provider? So they call themselves as a technology provider. It provides technology platform that connects customers, restaurant partners, delivery partners, in the process serving their multiple needs. Their footprint all over the country as well as outside India in around 23 countries as of December 31st, 2020. They say that the three key stakeholders are customers, delivery partners, and restaurant partners. On average, there are about 10.7 million customers ordered food every month on their platform in the fiscal 2020. They have about 161,637 delivery partners during the month of December 2020. And on average, during the year 2020, they had about 131,233 active food delivery restaurants on average per month. So therefore, their objective is to serve these three important customers. Who is the owner of this company? Interestingly, this is not driven by our usual family-driven company. This is a company which is more institution-owned company. We can see that except the founder, Mr. Goyal, Dipinder Goyal, who is holding 5.5% of the total share equity capital before the public offer. The other players holding more than 5% are most of the institutions. The largest investor is InfoEdge Limited, which is holding around 18.68%. So therefore, it is not a usual promoter-driven or a family-driven or government-driven or a financial institution-driven company. Let us see the financial statement, balance sheet, as given in the prospectus, and 3 years as well as the financial statement as on 31st December 2020 is also been given. Now we can see that the equity, which is an important number for our conversation, has increased from 12,000 million to 63,000 million by December 31st. But observe that on 31st March 2020, the equity was 7,033 million, which has come down from 25,600 million. So this we are going to examine how and why did equity come down and how did the equity go up in a period of from 31st March to 31st December. So in a matter of less than 6 months. But the corresponding to this increase, the asset side has increased in the current assets. So that means whatever money they have raised here, they have invested in the current asset. We'll observe these two as we move along. So overall, the assets of the company in the last 3 years increased from 13,000 million to 69,000 million. And the corresponding sources are equity, non-current liabilities, that they are not having huge liabilities on the balance sheet, and the other are the current liabilities. Now let us understand this equity. So the equity of Zomato, which we saw that was 12,000 million in 18, then 25,000 million in 2019, reduced to 7,000 million, and then a big jump in 2020, December, 63,000 million. How did this happen? In order to understand that, we should know what is the composition of this equity as shown on the balance sheet. Equity consists of equity capital, the capital of the company, which is contributed by the shareholder, and investments entirely treated as equity because of the classification of assets, classification of the instruments, and the other equity, which is share premium, the composition we are going to see shortly. So therefore, the equity largely consists of the capital, which is the money contributed by the owners, which is equity capital, which is in a normal, it is also called common shares or ordinary shares. But this investments in entirely in equity nature is actually not equity shares, but they are preference shares. Let us examine what is this equity capital, what is this instruments entirely in nature of equity, and what is this other equity. Since the prospectus is showing the consolidated balance sheet, the minority interest is also reflected, so that has been deducted, which shows the stake of other non-controlling interest holders in this company. So what is this capital? The capital of Zomato consists of authorized capital of 8,800 million equity shares with a face value of 1 rupee. So therefore, equity capital, authorized capital is 8,800 million. And the preference shares, and this is which has been used extensively by the company, not just the preference share, they have used compulsorily convertible cumulative preference shares. That is why, since they're compulsorily convertible preference share, that is why the balance sheet shows these are the instruments which are entirely equity in nature. But today they are preference share, are a type of preference share. So these preference shares are by default treated as instruments entirely equity in nature. So for all purpose, they're treated as equity share. But de jure, today they are the preference shares. And what is this other equity? The other equity is we can see that other equity, which has increased from 10,000 million to 59,000 million, though by March 31st it came down to 4,000. What is this, the composition of this other equity? Why is this other equity important? We can see that the other equity is responsible for the change in the equity of the company, is responsible for the change in the equity. So this other equity consists of share premium, the security premium, retained earnings, and small other changes in the form of which goes to OCI, other comprehensive incomes. So the big components are the share premium and the retained earning. Now observe this. The retained earning is actually the profits and the losses made by the company during the operating from their operations. And this is what shows the operating health of the company. We can see that the retained earnings of Zomato has been negative from 12,900 million to 54,000 negative. So that means the company has been making losses all through these years. We'll examine these losses soon. But so the big chunk of the other equity is the retained earning, and the retained earning has been negative. And the retained earning is negative because the company is making loss. But how did then positive other equity happen? The positive other equity is attributed to a big chunk of the share premium has been collected from by issue of the CCPS, that is preference shares. So the significant amount of premium has been collected, or the cumulative preference shares have been issued at a very high premium. So therefore, if I go back to the balance sheet, the change in the equity is because of two important reasons. One is the retained earnings, which has been negative. Retained earning of Zomato has been rising, and a big chunk of the equity preference shares have been issued at a very high security premium. So what did they do with this money? The money that they've raised have actually invested in some current assets. And we'll see when we go to the cash flow, and a significant amount of investment in the current assets is in actually the mutual funds investments. Okay, now this retained earnings, which is actually the reflection of the operating efficiency or operations of the company, comes from the losses from the income statement. And that's what is very important for a potential shareholder to understand. We can see that the income, the top line, has increased from 4,800 million to 27,427 million year-end, and up to December it was 13,600. So the operating top line has been rising. But what is important is the bottom line. The bottom line is a profit. So all through these 3 years and the latest up to December, we can see that the bottom line is in red. So that means the company is not able to generate profit yet. So Zomato is a loss-making company. Will the in the near future, will this loss become positive? Will the company generate or start generating profit? Is an important question for the potential shareholder. But why there is a loss? We can see the composition of the cost. The two important headings or the items on the income statement which account for a significant part of the expenses is the employees' cost and these other expenses. We'll examine what is these other expenses. So the employee cost is 5,491 out of 17,000 crore. Around 1/3 of the total expenses are employee costs. But it's more important to know what is these other expenses. Let us see the composition of other expenses. The other expenses are power, rent, repairs and maintenance, traveling, advertisement, commissions, postages, and many others. But if you observe two important items, that is advertisement and the outsourced support cost, that is 3,000 and 3,600. 6,600 is accounting for out of 9,467. So the business of Zomato is driven by advertisement, right? However, the prospectus says that advertisements and sales promotion expenses over a period of time has been falling. That means the company is not spending so much money on the advertisement. We can see that in 2018, 16% of the total income was advertisement. In 2019, 88% of the revenue went towards the advertisement. But slowly it is coming down from 88 to 48 to 22. So that means the advertisement to sales ratio is falling. That means the sales, the returns of advertisement has been increasing, which is a good thing for the company. But what is more interesting, as shown in the prospectus, is the unit economics of this company. Up to 2020, a unit means the order per order, economics per order. We can see that per order, the company lost about, is to lose around 30 rupees per order. How is that? Per order, the commissions and other charges, their income was 43. Some customer delivery charges was 15 rupees. So the total income per order is 43 plus 15. So that is 68. But the expenses to execute that order was 52, the delivery cost, discounts are 21, and 35 as other variable expenses. So therefore, 52 plus 21, 73 plus 15 is about 86. So the 87. So around 30 rupees per order was the loss, which is normally known as the unit economics. So unit economics of Zomato was in red in 2020. But the situation is improving. In 2021, in 9 months' time, they are seeing that the unit economics has improved from negative 30 to positive 22. How did that happen? Because their inflows have increased. Okay, it was 62, it was 43 and 15, now it is 62 and 26. And the delivery costs and other costs also correspondingly reduced. So as a result, the positive unit economics is definitely a positive sign, which will, if that continues and this positive improves, then the bottom line of the company will improve. But that is where maybe the efficiency has to go up, maybe more technology which is needed to improve the service. Now, this is important for us to understand. The company is making loss. That is what we saw here. But an important question is the company able to generate cash? So for that, we have to see the cash flow statement. Again, the source is the prospectus, okay? As expected, the company's cash from operating activities have been throughout negative. That means the business is not generating cash from its operating activity. That's a sign of any startup. That negative CFO is not a problem, because there is a possibility that over a period of time, the CFOs will become positive. But where is the money coming from? We can see that all through these 4 years, the CFI, Zomato has been aggressively raising money through different sources, through equity, through their preference shares, particularly through the route of preference share. They have not been touching the loans or the borrowings or the bonds, but it is a financial instruments in the form of cumulative convertible preference shares. So in 2020, we are able to see that the company has raised a huge amount of convertible preference shares, and that too at a premium. And what did they do with that money? They have used that money to invest in the I'll not say invest, but they park their money, cash, in a liquid mutual fund or liquid sources in the mutual fund sector. So the future, to a large extent, depends on how is the company using this liquid cash. Besides that, now, since they are going to go to the capital market to raise money, So along with this cash, which is already there, parked in the liquid funds, with the new money which is going to flow into the company through IPO, the company has to use and properly plan for its application. So the equity has increased because of the preference shares. The losses have been increasing, but that is a positive unit economics. And but despite that, we can see a few numbers which are definitely in red. That is earning per share. All through it has been negative. So 0.33 negative in 2019, minus 2.39, and minus 5.9 in financial year 2020. So earning per share has been negative throughout. Similarly, as expected, the return on net worth or return on equity will also be negative. So minus 8%, minus 37%, and minus 113%. And so a lot is required to be done to improve the EPS and RONW, or return on equity. Now, with this background, the company decided to go for IPO. The size of the IPO, one of the largest IPOs of the recent years, is 9,375 crore. The face value per share is 1. The issue price was 76. Though there was a ban, the shares were issued at 76, 72 to 76. And out of this 9,375 crore, 9,000 is an IPO, fresh issue of shares, and 375 crore is the offer for sale. Particularly one of the shareholders, as we have mentioned it previously, that is InfoEdge, is divesting its stake to the extent of 375 crore. In future, one of these sessions, we will examine the role of InfoEdge balance sheet on, or the impact of InfoEdge on Zomato. So what will be this 9,000 crore? Because out of 9,375 crore, 9,000 will get into the balance sheet of Zomato, will get into the cash flow statement of Zomato. What will they do with that? As per the prospectus, they say the money will be used for acquisitions, inorganic growth, and organic growth, but is for tech and customer acquisitions and meeting other general corporate expenses. This cash is also expected to meet their cash burnout, money required for next 7 to 8 years. So that means this cash which is now getting into the company, and also the liquid cash which is there with the company is poised for a really big growth. Will the company grow through acquisitions? Or will the company grow by improving their own systems and more and more customers, or improving their efficiency? Only time will tell. And though the issue was made at 76, immediately within 4 days, I think the company decided to go for the listing. Okay, the listing was preponed, and the listing was made on 23rd instead of 27th. So, and the market opened quite positive response, with a positive response. The price went up to 126, from 76 to 126. The price was up by 66%, or rupees 50, from an IPO price of 76. So those who bought shares on the primary market actually made a big killing there. But we can ask a question: will the institutions which are holding a significant stake on the company will divest the stake? So only time will tell. Though the promoter is saying that most of the investors are in Zomato with a long-term perspective, not to make money in the short term. So the total market capitalization as on July 23rd, that is on Friday, is about 98,200 crore. In fact, in the intraday, the price went up to, made the market capitalization to 100,000 crore, but it settled down at 98,211 crore. We have to see what will happen on Monday, that is tomorrow. Okay, so now it's a time for you to understand, should you continue to hold the shares if you have purchased? If you have not purchased the shares, should you go to the market and buy the shares at 126? We don't know. It's very difficult to say, though many analysts are already saying that the price is, Zomato is overpriced. Understand the fundamentals of the company. Understand the future of the company. Understand the ability of the company to use the huge amount of cash which is going to be there with the company. So the future depends on the organic growth which they are planning, or inorganic growth. We have to keep a watch on this company to see the ability of the company in using the money. So if you are interested in absolutely a short-term risk taker, maybe put in few thousands to participate in the hype which is there in the market. But observe and examine the fundamentals and then decide, because other players are equally efficient which are there in the market. So it's a time for you for some stacks, but will you go for Swiggy or Zomato? You have to decide. Thank you very much.